Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 12.50% year to date. We compare our model portfolio to the returns of the S&P 500 buy and hold investor. Their portfolio is up 14.5%, so we are trailing by 2 percentage points. The stock market strength color signal has changed. It has gone from green to yellow this week, showing deterioration in the broad market of the S&P 500. I'll show you that in great detail in this presentation. Here are some past returns for our model portfolio. Last week, the S&P 500 lost 0.05%. We made no trades last week. Here are the trades we've made so far in calendar year 2024. If you want to see all my trades going back 3 years, you can head over to this link. It will be down in the description down below. We currently have one open position of 200 shares of SPY. We purchased those on 129.24, and as of today's date, they are valued at $544.22, so we have a gain of $11,294, or 11.58% for the 152 days we've been holding this position. Our goal here at SPY Trader Now is to beat the returns of the buy and hold investor. If you want to see how I trade the portfolio in an effort to do that, go ahead, smash that like button down, subscribe to my channel, and ring that bell. This is the equity curve for our model portfolio for 2024 year to date. This is the equity curve for the buy and hold investor for 2024 year to date. And here are the two equity curves combined on one graph in a percentage basis so that you can see how well our model portfolio in blue is doing compared to the S&P buy and hold investor in pink. Here's the Fed Chair, Jerome Powell. The next Fed announcement will be on July 31st, about 1 month away. The expectation is that they are going to hold rates for the next 2 or 3 cycles here because they don't want to have interference with the election in November. So far, the Fed has done nothing all year except holding rates. Now we are looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500 and over here for the NASDAQ 100. Currently, President Joe Biden is in the 4th year of his term. Historically, for the S&P 500 buy and hold investor, that averages 6.7% on an annualized basis. Currently, the S&P buy and hold investor is up 14.5%, giving plenty of leeway for this market to have a correction between now and the end of the year. Now we are looking at things from a bond market outlook, and the bond market is saying to stay out of the stock market. The reason being is twofold. Number one, you have what's called an inverted yield curve, meaning that the shorter term 3-month and 2-year yields are a higher yield than the longer term 10-year yield. So, and you also have rising interest rates. So the interest rates are going up, although over the past week they actually did taper off by just a very small amount. Now, looking back at, because I track this every week, we have been inverted since November 19th, 2022. That is a 1.5 years with an inverted yield curve. This yield curve will go back to normal eventually. And then after that, normally 1 to 4 months after that, the S&P 500 will experience a minimum of a 15% correction, historically speaking, on average. So we want to be prepared for this whole event. And we do want this inverted yield curve to normalize to a normal yield curve. Now, here is our friend Warren Buffett, the Oracle of Omaha, the best trading stock market investor of all time. And this is CNN Business Fear and Greed Index. Currently, we are right on the borderline of fear and neutral. I'm surprised it's not higher this way. Kind of telling you that you've got more room for this. This is telling you that it's okay to go long in this market right now because we're not in greed or even extreme greed, which is showing very, very top heavy. Now we are looking at things on a seasonality outlook. Last month, the S&P 500 in the month of June gained 3.53% with this very healthy green candle. Now we have to look at July. So I've got July identified here, going back 20 years for the S&P 500. On a seasonality basis, 79% of the time, going back 20 years, you have closed the month higher than when you opened the month. Very important to know that. Now, another thing to take in mind that going back 5, 10, 20, and 30 years, you've got historical rates of return for the average annual S&P 500 return. You average somewhere between 7.51 and 10.41. What are we at now? We are at 14.5. Well, according to this, we are top heavy. We are a little overextended on the returns on an average historical basis. Now, remember on the last page, I showed you going back 20 years. In July, the S&P 500 had a 79% probability. Now we're going back 5 years, 100% probability. Going back 10 years, month of July, SPY 100%. These are extremely strong seasonality readings to tell you that you are not going to lose money in the month of July going long. Now we are looking at things from a long-term 20-year monthly chart of the S&P 500, and you are clearly in a long-term established bull run. Very healthy, strong, nothing but traveling from south to north. Now we are looking at things from an intermediate term outlook. 5 years, weekly candlestick chart. And I do see a negative divergence here. The MACD is traveling south and the S&P 500 is traveling north. Normally, this is a reasonable indication to tell you that this is going to follow suit and come down, which is contradictory to the seasonality chart I showed you, because we are now going to be entering in the month of July, and the month of July is a strong month. So one of these two indicators is wrong. Either this negative divergence is wrong, or the seasonality basis is going to be wrong this year. Now we're looking at things from a short-term outlook. And this is going back 6 months, daily candlestick chart. You can see the candlesticks very well here. I have my line in the sand drawn at 536.86, which is right here at before the gap. We gapped up here and went into this trading range that we're in right now. I would not be surprised for this to come down and fill the gap, or even overshoot it. See this line right here on the last high that was made over here in April? And then we came down, came back up, surpassed it. Then we came back down, danced around these numbers for 3 days, and then went north and did not look back. Could we be doing something like that right now? Anything is possible, but clearly, if you start coming down and going below 536.86, you are starting to enter into this territory over here. So you're going to start be looking at some type of a pullback. Plus, the summer's doldrums are coming up. Now we are looking at a ratio chart for the NASDAQ 100 against the S&P 500. On the ratio chart, normally you want it to be traveling north. Now the ratio chart is the chart that's in red and black. The S&P 500 is the chart that is in dark blue. When you do normally want the NASDAQ to be leading the S&P 500, and that is also positive for the S&P 500. You can see when you travel north on the ratio chart, you travel north on the S&P 500 chart. When you travel south on the ratio chart, you travel south on the S&P 500 chart. So what is happening? We came up and did a straight vertical on the ratio chart and then started traveling south. We bounced, but now we are hitting a line of resistance right now. And this line is a line that was drawn here, which was once acting as support. Well, now we blew through that, but now we've came back down. Now it's going to act as resistance. I would not be surprised if this follows through and comes down to at least tag this line over here, if not even go down further. So I would not be surprised to see that happen on this chart. Now, supporting a negative movement on the ratio chart, you also have the MACD traveling south below its signal line, slow stochastics traveling south below its signal line, giving you information that's showing you that this looks like it wants to travel south. This is another ratio chart for the equal weighted S&P 500 against the normal cap weighted S&P 500. Now, for those who are not in the know, the cap weighted S&P 500, there's about 7 stocks that carry 37% of the weighting of the S&P 500. So when you talk about the top 30 stocks of the 500 stocks that are in the S&P 500, well, that narrow number of 30 stocks is carrying a majority of the weighting of the index. So this is it's a much narrower weighted index compared to the equally weighted index. Now, I have the RSP equally weighted index in lime green, the cap weighted S&P 500 in dark blue. You see, under normal healthy markets, the equally weighted does surpass the cap weighted. Well, right now, you've got the equally weighted underneath the cap weighted. And in addition to that, on the ratio chart, you are down here in the toilet. We are at a level, this chart, by the way, is going back 20 years. In 20 years, you've never, ever been this low. This is uncharted territory for this ratio chart that we've been in. Now, when you are down here in the toilet, normally the S&P 500, which is in dark blue, corrects. Here it corrected 19%. Here it corrected 40%. Now we've gone down here in the toilet and we had a very small, mild 10% correction here. Is that going to be it? I wonder. It seems like it's not going to be it. We'll experience, I think, another 10% correction or something like that. But the ratio chart is bottoming here and the slow stochastics. So it looks like it's wanting to travel north. I mean, it's so rock bottom low. The only place it really can go is north. So it seems like we are going to, come up. And once this ratio chart does come up and correct here, and you start getting this activity, well, we absolutely want to be long, but we just don't want to get caught if it's going to do one of these things right here. Now we are looking at the VIX Volatility Fear Index. And what is this telling you? It's telling you there is absolutely no fear in this market. Why is that, Ken? Why? Because we are in the ultra low trading range. When you're below this green line, this is the ultra low range, below 16. Between 16 and 20, you're in a low range, still healthy and bullish for the market. But when you start crossing above 20 and you start going north of 20 on the VIX, well, that is when the S&P 500 there's fear in this market, and the fear is driven because the S&P 500 is going south. So that's how this whole thing interacts. But right now it's down in the toilet. And also the MACD looks like it wants to cross below its signal line. Slow stow is traveling south below its signal line. This tells me that the market is going to stay bullish at least for the short term, for right now. That's what the VIX is telling me. Okay, now we are looking at a 3-year weekly chart for the S&P 500. And here I've got my cycle brackets here, and this low here kind of corresponds with that low. This one corresponds with that low there. This one corresponds with that low, and so forth. So these are my cycle brackets down here at the bottom. And then I've got half cycles here for the minor cycles, like this low right here corresponding with that low. This low here hasn't really established itself yet, but it should be somewhere around coming up here for when it wants to drop itself. So, and then this one here didn't really establish itself. Right there was a very small pullback there. So none of these don't always line up 100%. So you got to take the exact timing with a grain of salt. But generally speaking, these are how I've got this established. Now, with that in mind, I also have this Fibonacci extension drawn in here with a target zone in red. And you can see that where we are right now, it is very, very close to this red right here. So we're almost at the target zone. I also have standard deviations. That's the +2. This one is the -2. +1 in pink, -1 in pink. Where are we at? We are very close to the +2 on a 3-year weekly chart, telling you that there's not much upside left. I don't know if this target is going to be hit, at least on this chart. So there's limited upside is what I'm trying to explain to you here when you look at this chart right here. Now let's go over and look at the daily chart. So let's go to a 1-year daily, and let's change our cycles to the 1-year daily, which is this chart right here. Now, when you're looking at this here, and let's just blow up this, we'll look at it this much. Okay, so I've got my cycle brackets down here at the bottom, and you can see kind of what's going on. This low here seems to correspond with that. This low seems to correspond with that. Now there was another low here that I wasn't 100% sure that's dotted that was a possibility. This low would have corresponded with that one. This low would have corresponded with that one right there. And then if that was true, this is going to continue on. If this dotted line actually has validity, it's going to take out that high right there. Right now, it has not done that. And it is possible that this other cycle bracket is going to be the dominant one, and this is going to come down and possibly come down over here. So not 100% guaranteed. But what do we know? Well, if we take a cycle from here to this low, to that low, or even if you took it from this low, it really wouldn't matter. But with this Fibonacci extension, you'll see that I've got drawn in here the 61, the 78, and the 100. We tagged the 78.6 here, came down, tagged it again, but couldn't close above it, showing you a rejection candle at the 78.6. That was on Friday's trading. Now that's important because, and this line here, this dotted line that I'm showing you right there, that's my valid trend line, showing you this, the low from here to the low to here. I got 10,000 arrows on here. Let's get rid of those. Okay, so you got a lot going on this chart. Dotted, this dashed line here gets broken, that's going to be negative. Is the low this low here, or is the low this low here? A little unclear right now until we start breaking something. But it looks to me like I'm getting the impression that this is going to start doing something like this. That's the impression that I'm getting, how this market is going to play out. No guarantee exactly how it's going to play out, but that's the impression that I'm getting looking at this chart. The stock market has a holiday next week. We have Independence Day. On Thursday, July 4th, the stock market will be closed. All right, now we are looking at a spreadsheet that I created to determine the health of asset classes and also the 11 sectors for the S&P 500. So I could look at them on an individualized basis to determine, kind of what's going on with both subjects here. So when we look at asset classes, last week we were at 59. This week we're at 57. So you've lost a little bit of strength amongst various asset classes. I put them in green when they have 5s and 6s, which are very high numbers. Anything below a 5, 4 or below, would not be highlighted. So by looking at how much green you got on the screen can determine how strong you are. So you're losing strength. Now look at the less green you have on this chart compared to last week. We are totally traveling south on multiple sectors for the S&P 500, and we went from 64 to 45. So I know that broadly across the board, we are definitely losing strength in this market. Very negative signal that I'm seeing here for this market. This chart is telling me to be more bearish in the short term than bullish. Now we are looking at the 10-year bond yields. This is a 1-year chart of the 10-year bond yields. What is happening here? Well, the chart that we're trying to focus on here is the candlestick chart. The chart that is in black, that's going to be TLT, which is 20-year bonds. SPY is going to be dark blue. So that's the S&P 500 in dark blue. What happened? About over the last week, we found support at this green line here, bounced and started traveling north. And TLT, the bonds, did not like that. Bond prices definitely went south during that time. So if bond yields continue to travel north, you know that bonds are going to 100% travel south. Now, normally speaking, when bond yields are traveling north, not only does bonds not like that, but normally you also have a pullback in the S&P 500. Now, the S&P 500 really did not have a pullback. It just moved sideways, which is kind of delayed. So it looks like look at the MACD and the slow stow. They want to travel north. That is the candlestick chart. That is the 10-year yields. If the 10-year yields are going to travel north next week, not only will TLT lose steam, SPY will also lose steam and travel south. Bearish. This is bearish information if this continues to travel north. Now I got a dotted line here because that seems to be a line that has showed resistance and support in the past. So this line, which we are just above right now, is a line of some importance. In this position, the 10-year yields, they give this line validity because it has shown that the market is looking at this level right here, which is about what, 43.4 approximately. Where are we at? 43.43. We are literally just above it, but not comfortably above it enough to say that, oh yeah, we're traveling north for sure. But the evidence is supporting this to be traveling north. And if it does, the SPY will travel south, at least starting the month of July off, traveling south. So something absolutely to be watched every day. Okay, guys, I've just given you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? Well, June 29th, 2024, the market summation, according to me, Ken, your friendly host for Spy Trader Now. The stock market is losing strength, as noted in our yellow color signal. The cycle low is expected in about 1.5 weeks. Take that with a grain of salt. As I explained, it's a little unclear which of those two cycles that I showed you in the chart the market is going to follow. But if that's true, over the next week and a half, you're going to lose steam, taking us below that valid trend line that I showed you on the chart. Now, seasonality. We know that July is a very bullish month. So trying to go in a bearish position here, looking at it from the seasonality basis, boy, you gotta be really strong in your position in an effort to do that. Now the VIX is in ultra low area, and there is absolutely no fear in this market. Our line in the sand is identified as 536.86, and then you're going to start seeing the fear increase in this market and things start changing. And below, we're going to explore short positions. Well, I'm actually exploring short positions right now, so we don't wait for nothing here. So positions that I'm considering taking on, okay? I am considering taking on, now in here I wrote down two puts. I'm going to buy 2 long puts. Here's the exact put, 490, June 20th, June 20th, 2025. So it's actually going out a whole year. So in that, if I do get 2 of them, that's $2,266. I'm also considering, and possibly even doing simultaneously, is selling an in-the-money covered call. So I currently have 200 shares of SPY. Well, I can sell the 490 call, and I'm going to go out to the end of the summer doldrums, which is October 18th, 2024. And how much am I going to get paid for this? I am going to get paid $65.12, a total of $13,023.61 after commissions. That goes right into our trading account as cash available to spend on whatever we choose to spend it on. So we are going to have plenty of cash here if we decide to do this. These are those 2 positions that I just showed you. Now, breaking down the covered call position a little bit more, I put in here in my calculator. By the way, if you go to my website, the description is down below. You can download this calculator for free if you so choose to use it. SPY stock price as the current trading price, $544.22. The option premium, according to the call, is $65.12. Plug that in with the strike of 490, which we have right here. 200 shares. If we do both, we don't have to. We can do whatever we want to do, but we could just do 100 shares or 1 contract if we so choose to do so. But it seems like this market is going to pull back to me. I'm thinking that this is my forward thinking on my thought process with all the information that I showed you. There were some cross currents. July is a strong month. And even if July is a sideways month, what happens when you sell a covered call? You're getting paid if the market moves sideways. Not much but you are getting some call premium. Now, we know that we're in the money here. So the intrinsic value of this is $54. Well, I'm going to get paid $65. So that is $11 I'm going to get, or $10.90 of time value. This is how much I'm going to get paid just to sit in this position. So if the stock market goes completely sideways and doesn't go north and doesn't go south during the time between now, 7/1/24, which is Monday when I can place this trade, and the expiration date of 10/18/24, which is exactly 109 days away, well, I'm going to get paid in order to do that. And I'm going to get paid $2,260. So that's not bad cake to be made. I'm going to get a 7.9% annualized return if I was to do that. The actual return will be 2.36%. And we'll add that on to our current position, which was, what was that? 12, I think it's 12% right now is what we have for the current position. This is the 2 positions that I'm strongly considering taking as early as Monday, because I think that these positions are both going to pay off. That's my thought process right now. And you know what's interesting here is that if I buy these two calls, the $2,266, I'm sorry, buy these two puts, the money for these puts is going to come from the profit of my covered call position. So making this position practically free. So not bad. I mean, you know, I'm still going to have a profit. I still have a profitable portfolio with everything that's said and done. If the market doesn't do anything and this put never pays off, and I ended the year with where I'm at now, I'm going to get a 12% return for the end of the year. Not bad cake. You know, it's not 14%, but 12% is still 12%. Now, if this market does what I expect it to do and pull back a minimum of 10% over the summer doldrums, well, believe me, I'm going to be doing a lot better than 14% by the time the end of the year rolls around. This is going to pay off handsomely. And that's if I didn't even add to my put positions, which we can absolutely do. If this thing starts unwinding, we could add on and put on a couple more puts. But these are the transactions I'm seriously considering putting on Monday. These, I don't see a problem. Let me know your thoughts in the comments section. Do you think that this would be an appropriate trade to make, or do you think I'm way off base and we should be completely bullish at this expectation? What are your thoughts? Love to hear your opinions. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, ring that bell. I thank you and wish you good trading.